Welcome in to another Tax Talker. Today, it's back to basics. These are three fundamental things you should understand about how tax returns work in the United States. Let's get into it. Number one thing is that the tax return is fundamentally a reconciliation. You're calculating a total tax number, you're calculating a total payments number. Payments greater than tax, you get a refund. Payments smaller than tax, you owe money. You'll hear people say things like, oh, I get taxed so much on my bonus. And all that means is their bonus gets subjected to special withholding rates. If they pay in more throughout the year, they're going to get more back when everything's reconciled. Come January, February, during the Super Bowl, we'll see a zillion commercials. File for your refund, get your refund, we get you the biggest refund. There's no such thing as just filing for your refund. You can certainly owe money. Why is that? It's because the tax return is simply a reconciliation product. You're taking, according to law for that year, you aggregate all your income items, any applicable deductions. Subtract that from the income item, you arrive at taxable income. From there, you apply the tax rates and you get a tax number. And again, going alongside this, you aggregate all your payments. Most of us, that's just our W-2, but you could have multiple W-2s, you could have retirement withholding, Social Security withholding, you could be paying quarterly estimates. All of that gets compiled into a payment number. And again, at the end of the day, payments, tax, which one's greater, which one's less, that's going to determine whether you have a refund, whether you owe money. Balance due does not mean you did anything wrong. In fact, you can have a balance due and not be penalized at all, as long as you meet safe harbor rules. Safe harbor should have a video in itself, and it will. The safe harbor rule is right here. Basically, if you pay in a certain amount of money throughout the year evenly, then no matter how much money you owe in April, there's no interest and penalties. Conversely, all a really big refund means is that you gave the IRS an interest-free loan. Moving right along, let's talk about the second item here, and that's credits and deductions. We hear these all the time. That's a big write-off, or I'm getting a kickback on that on my taxes. Everything's always a loophole, or the buddy on the golf course has figured out a way he pays zero tax via some deduction. What are these things? Again, going back to that reconciliation process, in the same way you have your standard income items, there's also standard deduction items. These are preferential items within the tax code, like donations or mortgage interest, student loan interest. There's a lot of these items. If you earn business income, you can deduct expenses against it that were ordinary and necessary to earning that income. That's a type of deduction. There's all kinds of these, and all these do is reduce income, your total income, in arriving at taxable income. In contrast, a credit is on the tax liability side of things. Once tax has already been calculated, then you have to see if any credits apply against it. A credit is going to be a dollar-for-dollar reduction in tax. Again, there's a lot of examples of this. Really common ones would be the child tax credit or education credits. A dollar-for-dollar reduction in tax, that sounds like a good deal. That might sound like credit's better than a deduction. You might hear people throw out statements like that, but 99% of the time, it's just comparing apples and oranges. There's no reason to pit the two against each other. It's pretty rare where you're choosing between them in the tax law, and so it's kind of meaningless to say one's better than the other. There are some generalities, though, we can say. Generally, the higher your income, the more impactful a deduction will be. Let's say you have a $1,000 charitable write-off. Well, in the 10% bracket, that's going to save you $100, right? Instead of your income being X, you've reduced it by $1,000, so 10% times that, that's $100. If you're in the 35 or the highest bracket, the 37% bracket, well, that same deduction is saving you $350 or $370. A credit, on the other hand, would not have a bearing on that situation. Credits, you typically either qualify or you don't, and then it's a dollar-for-dollar reduction. However, many credits get phased out at high income levels. On the very low end of the spectrum, many credits don't benefit you if you don't generate a tax liability. You need to have a tax liability in order to offset it with a non-refundable credit. There are exceptions to this, like the child tax credit and the earned income tax credit, where you're actually being paid money via your income tax return, you're getting a refundable credit, meaning even if you don't have tax liability, you can still get a credit. The other general rule I would say is you don't really want to chase these, meaning you don't want to modify your behavior very much in order to get them. At the margins, if you're going to do something anyway, you might change the timing of when you make that deduction in order to get the charitable deduction in this year versus next year. But again, at the end of the day, you make $1,000 charitable deduction, you're saving $100 to $300, you're still out the $1,000. Similar with a credit. You have a child, okay, you got a child tax credit of $2,200, you still have a kid, and I don't think anyone's having a kid because of the child tax credit. All that to say, these preferred items within the tax code, it's nice that Uncle Sam's giving you a kickback, but you really don't want to modify your behavior too much to chase these things. It can lead to just poor financial decisions. Moving along to item 3, let's talk about tax rates themselves. Remember, we had our income, we applied applicable deductions, and we arrive at taxable income. And then that taxable income, there's tax rates that apply to it. There's a lot of confusion about how tax rates work. You'll hear someone say something like, oh, I got a big raise at work, but now I'm in a much higher tax rate. I don't really get much more money. That's not really how the tax system works. The brackets, you could better understand them as tax buckets. As you see them on the screen here, as you go up the income spectrum, you fill up each bucket at that applicable tax rate. So you fill up the 10% bracket and the 12% bracket before moving on to the 22, 24, and so on bracket. So if you got a raise, it's only the marginal dollar, the dollars that overflow into the next bucket, that are getting taxed at that higher rate. This is what people mean when people say our tax rate system is a progressive system, meaning the rates do get progressively higher as you move up, capped at 37%. So when someone says, oh, I'm in a high tax bracket, what they mean, if they know what they're talking about at all, is that they're in a high marginal bracket, meaning the marginal dollar, the next dollar they earn, is subject to, say, the 35% bracket. Or, importantly, the marginal deduction is going to save them 35 cents on the dollar. Those marginal rates are important for how you do tax planning, and the more one-off, you're having a high income year for some reason, well, yeah, then you should do things to increase deductions as well. But as your income increases, it's also just good to step back and take a look at your effective tax rate. And that is your total tax divided by your total income. This gives you a sense of basically the average tax rate you're paying across all these different brackets or buckets, as it were. And what you'll see is that effective rate is much lower. And of course, following the one big beautiful bill, right now, tax rates are at a historical low and they will continue that way. There you have it. That is the Tax Talker for today. Those are 3 basics, 3 items that will help you understand your tax return better. If you like this comment, be sure to like, comment, hit that subscribe button. Let me know what questions you have on the recent tax bill or anything else in the world of tax. Thanks for watching. We'll see you next time.